Muy buenas tardes a todos. I know we can keep talking and talking, and I'm one of those, and lose track of time, but I wanted to start the program this afternoon. So, muchísimas gracias por estar acá. Good afternoon, everybody. I'm Patricia Pacheco. I'm a managing director. For those that may not know me by now, I'm a managing director, market leader in private bank, New York City. And I also drive the diverse segments business development strategies for the New York market in private bank. But I also have the great honor to be the co-chair of the Hispanic Latino Executive Council, which comprises of the highest ranking Latinos in Bank of America nationally. And our mission, it's very simple, is to help drive Latino representation within Bank of America, but also influence our investments in our community externally, and make sure that we have a voice as Hispanic Latino internally in Bank of America to drive that change. Secondly, I am the co-chair of the Hispanic Latino Business Council, New York City, together with Irina Sirota, who is our head of business banking in New York City. And we're so pleased and proud to be hosting you today, to be sponsoring today's event, supporting Angeles Investors Q4 pitch. So thank you very much for giving us the opportunity to host you. And I hope you all enjoy this incredible facilities. These are brand new. Some of you probably got lost getting here. Probably your taxi dropped you off in One Bryant Park. But this is our brand new facility, so enjoy enjoying them as much as we have the last 2 months. I wanted to provide you a quick context around what is Hispanic Latino Business Council and what is our mission, and also talk about some key examples of how we're driving and supporting our communities, driving change and supporting our communities here in Bank of America across the country. So the Hispanic Latino Business Council, we are about 20 of us across the country, and we represent different leaders across different line of businesses, small business, business banking, Merrill Lynch, private bank, consumer banking, investment banking, global commercial banking. And the objective of these councils is very simplistic. It's to make sure that we're working as a united front, as one bank, to bring our solutions and our expertise and our advice to our Hispanic Latino communities across the country. So why 20 of them? Why 20 councils? Because we have worked on a strategy across Bank of America to focus on the 20 most high-dense Hispanic Latino local communities, local cities. So I know, Angeles, you have events in Miami, you have events in Chicago, here in New York City. So I'm definitely look forward for us to partner with you across the different cities where we have our councils, like in Miami, AKA. Just pitching right away, because I know the bank is trying to do this, but this is better than PNC, FYI. So what does these councils do, right? So we provide basically financial advice across all the different sectors, but we're very proud of that. I'm very proud to be part of the launch of HLBC New York City now for 2 years. We launched it during COVID, which was very difficult. But since then, we have sponsored a couple events, including Latitude New York City last summer, which many of you were there. So I also wanted to share a little bit more about our investments in terms of dollars and in terms of initiatives, which I know for Angeles investors, some of this important statistics is you guys going to be very pleased. We have been working, as you saw, a lot of press releases since Black Lives Matter, a lot of investments that many financial institutions have made. We were making a lot of those investments already. However, what we did as a bank is just enhance it even more, but ponerle más leña al fuego, like they say in Spanish, right? More intensity, more focused. And I'm proud to say that we have done a couple now, it's actually our third, 1 billion, 2 billion bond, ESG bond, which was specifically to address racial and ethnicity equality and economic opportunity for Hispanic Latinos, African Americans, and Asian communities. And part of this proceeds went into specifically to support Latino and African American and Asian VCs. venture capital. And I'm pleased to report today that $400 million have been already approved across this program, and 135 million as of today have gone to Latino Hispanics VCs. So we have approved more than 37, and there's many of those in our pipeline, because we're not going to be happy until we hopefully fund every single one of them that exists. It's as all of you know, it's only 1% of the total VC investments going to Latinos. So it's critical, important for banks like us to really commit and really walk the talk around this effort. So happy to share that as well. In addition to that, we have committed and funded more than 300 million to CDFIs and MDIs, which are critical for our local communities. So I just wanted to share those couple highlights for all of you as responsible investors here, just to understand a little bit where is our mind in terms of responsible growth by responsibly investing and making a difference in the communities that we serve. And now I like to highlight and go into the agenda for today, because I know this is looking at me like, Patty, wrap it up, please, wrap it up. So let me just walk you through the agenda. So today we're going to have, during lunch now, we're going to have a panel discussion with some of our private bank investment management executives, and I will in a second introduce them. Then from 3 o'clock to 6 p.m., we're going to stay here where we have our pitches. Angeles investors will have the pitches and discussions with startup founders. Then at 6 to 8 p.m., we're going to go across the street in 42nd and 6th. Many of you know that building, but probably many of you don't know the 51st floor, which is our beautiful area where we do incredible events and where we're going to have a cocktail reception from 6 to 8. And there we're going to close today's event. And now, without further ado, let me introduce you to our moderator, Desi Natch, our market investment executive from Private Bank New York City. And I will also introduce our panelists, Bill Keller, our Private Bank Senior Investment Strategist in Bank of America Private Bank, and also Neil Mukherjee, Head of Portfolio Strategy from our Chief Investment Office. Guys, take it away.
All right, thank you. First of all, thank you for allowing us to host this event. This is a great privilege for us. We're also excited about sharing some information. Boy, has it been a roller coaster ride, right? Like, whoo, March 2020, and it's been up and down. We hope today we'll share with you some very good information. Please write down questions at the end. We will give you an opportunity to ask any questions, any thoughts on your mind. I want to kick it off because I know everyone is anxiously awaiting for what wisdom do we have. And again, 2022 has been a year. Just looking at September, we hit new lows. We had 6 consecutive days of losses in the markets, which had not occurred since the 40s. The dollar has strengthened. Interest rates rose sharply. We had these weird outliers where stocks and bonds had their worst performance. So I want to kick us off, and Neil, I'll kick this question over to you, is tell us what else happened? You know, give us an overview of 2022, and we only have about 6 weeks left here, and what can we look forward to?
Yeah, well, you mentioned March of 2020, and you know, when 2020 was ending, I was telling somebody, I can't wait for this year to get over. Then it was 2021, and I was like, I can't wait for 2021 to get over. And now, you know, you can guess where I'm going with this. So it's been a historically bad year for asset prices. Inflation. That's been the big problem, not just here in the U.S., all over the world. Why do we have inflation at these levels? It's a combination of many things. We spent a lot of money, way more money than we should have in terms of fiscal stimulus back in 2021. The Federal Reserve financed that by buying up a lot of those assets and keeping interest rates lower. So it was a policy mistake by the Federal Reserve to do that. I think they were easy for too long. At the same time, coming into this year in February, you had the war that broke out in Europe, which is the biggest land war that Europe has seen since the Second World War. That added to the upside pressure that commodities have been facing. That got back to inflationary numbers that we saw in the US, et cetera. So it's a combination of things. China, at the same time, have their zero COVID policy. That adds to the supply chain bottlenecks. But I think it comes back to that bad policy making that the Fed did. We've written about this a lot. We're monetarists when it comes to inflation dynamics. So the Fed had increased the size of their balance sheet, was growing money supply at a rate of about 25%. On a year-over-year basis, and they were doing this for a good 12 months. Typically, money supply grows at about 7%. So this was 3 standard deviations above that. And every time the money supply growth has gone up by that amount, inflation has broken out. It has happened after the First World War, after the Second World War. It happened in the 1970s, and now it's happened again. And so that's the dynamic, right? And as inflation has broken out to the upside, global economies are slowing down at the same time. So we've seen a slowdown in the US economy. The housing market has taken a big hit already. You've seen home sales decline by something like 50% if you look at existing home sales, new home sales. The building intentions, construction activity has slowed down a lot. Manufacturing is slowing down as well. New orders component of things like PMI surveys that we look at, that's slowing down. The US consumer is still in pretty good shape. I mean, that's the good news. I mean, the one thing that has surprised us all year is how good the consumer has been. So, that kind of makes sense because we stuffed the consumer with over 2 trillion in excess savings. And now that they have spent about, I would say, 900 billion of that, so they still have about 1.1 trillion in excess savings, assuming that they spend 100 billion of that every month, they could go through till next November, December with that spending power still intact. And plus the labor market is very strong and incomes are going up. So the consumer is hanging in there, but the big question is how long? That's the big question everybody is asking and nobody has the answer to. Now, outside the US, Europe's problems are well documented, their proximity to the war, their dependence on their energy needs from Russia, et cetera. That's all very well documented. I think Europe is already in a recession. They probably went into a recession sometime in the last 1 month. Again, I'm looking at the new orders component of the PMI ratios, and they're like at low 40s, right? So which tells you that manufacturing production is going to grind to a halt very soon. And obviously, energy bills there are 2 or 3x than what they were in 2019. So many of the factories are also slowing down production. So that's sort of the global picture as we head in to the last few months of this year. So the bottom line is that it's just very uncertain, right? So we talked about asset prices. The U.S. equity markets are still not pricing in sort of the recessionary scenario that could unfold over the next few months. It's trying to break out and do these bear market rallies. It wants to really believe that the Fed will pivot at some time, but therein lies the problem, right? Because every time the equity markets rally, it raises the antennas at the Fed, because they don't want to see these equity markets rally because it leads to a loosening of financial conditions. So, for example, when the retail sales number came out was very strong this week, and the CPI numbers, the PPI numbers were positively, they surprised to the market as well. The equity markets are up something like 10% since the bottom in October. The Fed hawks are out. Every one of the Fed speakers is now saying, we can take interest rates much higher. The pivot is not in the cards. In fact, James Bullard, he's the hawkish of the hawks. He came and said, hey, listen, 5% is a minimum for Fed funds rate. It could be 5 to 7. So this was the first time the markets heard the word, the number 7, right, with respect to the Fed funds rate. But the bottom line is the Fed will keep hiking. They need this very strong labor market to crack because, with inflation where it is at 7-8%, it'll be easy for that to come down to 4%. Going from 4 to 2 needs this economy to slow down quite a bit. That's why the Fed will keep hiking. They want this labor market to loosen up, and that's when they will see inflation come down, rents come down, and finally inflation coming down to their 2% target. So that's the overall picture that we are dealing with. Bottom line is higher interest rates in the near term, more volatility for equities, bond prices. I think bond market probably almost has bottomed. I think you can take more risk in the bond market, and we can talk about that later. But I think there's a recessionary cloud that is going to be an overhang in the first half of next year.
And your comments just solidify just all the things that are going on in our client's mind. Had a conversation this morning with a client that was a business owner who was like, "I'm flushed with cash. I can't get anybody to work, and I can't get any supplies. I mean, what do I do? I'm confused." So, Bill, my question to you is, what are some of those other top concerns that you're hearing from clients?
As Neil said, the challenge today is so dramatic in so many different areas, is that clients are struggling to comprehend, what do I think about first, right? And that is the great issue at hand. It is just a cacophony of issues pouring over top of them. My message to them is keep it simple, right? So Neil's talked a lot about the Fed. What is the old mantra with the Fed? Don't fight the Fed. So you need to ask, what is the Fed fighting? Well, the Fed is fighting inflation. So every question you have, or every topic that pops up, you need to run it through an inflationary kind of mindset. Is it helping inflation, or is it hurting inflation? And that'll help you kind of come up with the path of least resistance. We've spent a lot of time talking about the basics of economics, supply and demand, right? And how typically you'll have a supply break and prices will go up, or a demand spike and prices will go up. And what we've experienced now is both of those things happening. So you have to say, why did they happen and how do they unwind? And maybe you can figure some of this stuff out. Neil's talked about, what was it, how many trillions of dollars did we get between the Fed and Congress, right? It was 8-9 trillion dollars. 40% of the GDP was basically thrown out to us, right? And that's the demand side, all that money sitting there. And you think about when that money hit our accounts back in COVID, what did we do with it? Nothing, right? We couldn't go out, we couldn't spend it. And when we did, we all ran around and tried to find toilet paper, right? I mean, that was our big splurge, was to buy toilet paper. And you could see that drive keep going through the economy. It went from toilet paper to computer monitors to computer desks to remodeling, and then to new houses. And all that money sloshing through pushed the prices higher to where we're at today. Good news is the Fed can battle that down. Neil's talked about it. They have the power to raise rates, which decreases our ability to act on our greed, and the economy starts to slow. The challenge, though, I think, is on the supply side, and COVID may have pulled forward a number of long simmering issues. And all the issues we talked about, I put them in 3 categories. The first is, I no longer trust my neighbor, right? And we saw the first cracks of this when President Trump was doing the tariff battles with the Chinese back in 2018 and 19. That was the mindset of what the big issue was for the markets back then, was this upcoming battle of tariffs, right? And when you think about whether it's the tariffs, or no longer being able to trust things to get to me because of COVID, the supply chain breakage, or now we need to move things back to the U.S. for safety reasons, right? Onshoring or friendshoring. You're changing a real long trend over the last 40 years of, I trust my neighbor, therefore I can maximize my profits by utilizing the entire world. Now, as we start pulling back on that, it has some inflationary pressure. So that's number one. Number two is what we saw play out in Ukraine, right? We have a break in our energy policy. Neil's talked about Europe probably in a recession now. It's because Europe based its policy saying, we're carbon-based, we want to be green-based. The bridge through all of this is natural gas. And the natural gas comes from Russia. And if we do a lot of business with Russia. Russia has to be a good global citizen. And that hasn't worked out. I think it's been interesting. Angela Merkel, right, the most responsible adult in every room for politicians, has not been heard hiding her hair for quite some time because, again, that belief of cheap and sufficient Russian gas isn't there. So now we have some challenges where capitalism needs to come in and kind of rebuild that. Capitalism takes a long time to get profits back on building infrastructure. And we don't know if there's enough time before we hit the green environment. So we got some questions there. So again, a second inflationary piece. And then for any business owner or business developer today, I think it's the third one that we all experience, and that's the lack of workers today, right? This worker shortage. We've seen the trend happen over decades. Back in the 50s, labor force participation rate, which is really simply what percent of the looking at the population over the age of 18, what percent is either working or looking for a job? In the 50s, that number was about 57%. 2000, it had jumped to 69% because women entered the workforce, right? And since 2000, that number has been ticking down as baby boomers start to exit the workforce. Something happened at COVID that changed that because it had fallen from 69 to 64, and now it's just a touch over 62%. And we're trying to understand what that is. And the thought is what could have happened is you had baby boomers in the teens decade say, I'm living on really low interest rates and I can't live that way. So I need to go out and pick up a second job, a couple hours a week at a hardware store, something like that. And then COVID hit. Now I had a choice, a few extra bucks, death by COVID, right? That was kind of the decision. And they said, I'm out. So we've seen those folks leave. And we know the result is today we've got about 3 to 4 million fewer people in the workforce today than pre-COVID at a period where it seems like demand for workers are coming up, right? We're going to reshore people. We've got millennials, or excuse me, not millennials. We've got the baby boomers who are retiring. And they're saying, no longer do I want another TV or another car. I want to get on a plane and experience life. It's hard to supplant. It's easy to supplant hands on an assembly line with a robot. It's harder to do it, when you want an experience. So it looks like we're coming up to a period where labor is rising again. And you see it in strikes and labor strife and things like that. And we think labor will kind of strengthen its stance as we move forward. Again, there are 3 areas that are inflationary that the Fed is fighting, and candidly, the Fed's tools kind of struggle in that area. So I think that's a good framework for folks to think about. The Fed can control an awful lot, but these are kind of demographic long-term trends that maybe they're fighting that could cause inflation to stay higher. And that's why Neil said 8% is where we're at, 2% is the target. You probably got 4% from the Fed activity. What about that next 2%? How do we get down there? And then from an investment standpoint, how do you invest in a world where inflation's running at 4%? When most of us, for all of our lives, have lived where inflation is running much lower than that. So again, investing wise, Desi, we need to start changing our mindset around that.
We'll talk a little bit more about that as we're just piling it on,
sorry.
right? like we're just piling it on right now. Both of you, Neil and Bill, you mentioned policy, and here we are, right? Last week we had our midterm elections. Here we are, and we have a split legislature. So what are the thoughts around policy and the dreaded politics as we go into 2023? What do you see as some key indicators there?
You want me up?
Bill,
so I don't know how I drew the short straw in politics. Maybe we'll talk about religion right after this too, just to upset everyone. So it's interesting. What was supposed to be a wave became a whimper, right? We have a mildly divided government right now. And again, I like to say as policy decisions come up, run it through that idea of, is it going to be inflationary or deflationary, right? We saw what happened in Great Britain a couple weeks back, where you had a new prime minister do what politicians are apt to do. population you're hurting, inflation's hurting you, I'll give you something. We'll cut taxes, we'll cap rates, we'll do all this, and we'll deal with the ramifications down the road. So giving you money is stimulative for the economy, which pushes inflation higher. That was going up while Bank of England was trying to slow the economy to fight inflation. You got your two governing bodies working in opposite directions. Bank of England jumped in, had to take action, right? They changed their policy, and then we ultimately saw the government be changed. First time in a long time that you've seen kind of a first world country politician get knocked down because they doing what politicians traditionally do. So I think when you look here, the divided government now is going to make it harder for policy to be implemented, which should be good at keeping the inflation a little bit more in check. Allow the Fed to do their work without having to fight against political reasons. But we know we're now in a new election cycle, and there's going to be a lot of ideas and things tossed around out there in a period where what we thought was going to be an election driven by economics, and it really didn't. And I have my own thought on this. There's one economics joke out there that I've got to share with you. It's the only one I know, and the economists, we love definitions, but what's the difference between a recession and a depression? Nobody ever speaks up, right? The joke is a recession is when your neighbor loses their job, and a depression is when you lose your job, right? We had nobody lose their job. So even though inflation was uncomfortable and annoying, it wasn't catastrophic because I lost my job. So it was a big issue, but maybe not to the point where I said I'm going to have to make that be the only issue. So, Desi, that's the best I can do on a politics question.
And I appreciate that. And one of the things, Bill, you had mentioned, and Neil, I'll pose this question to you, was about being conscientious about our portfolio's and investing in this new market.
Yep.
So when we think about 2023, what are some of the considerations from a portfolio standpoint should our clients and our prospects and friends and family be thinking about?
Yeah, absolutely. Well, before I go to that, real quick on the elections, gridlock is good.
Yeah.
No major policy changes should happen. Here's some stats. Typically in a midterm election year, the equity markets tend to do well after the midterms, so 6 months after the elections, than they did before the elections. So that's a good thing. If we don't get any major new spending, that means inflation will probably not go higher because of fiscal stimulus. You mentioned this, which may be good for bond prices. In terms of sectors, I think energy can keep benefiting because Republicans like spending on energy. And the Democrats are also thinking along the same lines. Joe Biden has talked about this, that we need to increase our production of domestic energy. Defense will keep benefiting, even though Republicans are a little bit more skeptical about providing funding for Ukraine. They may still go ahead because the world is a very dangerous place these days. So all of these dynamics will come into play. I think Bill and I were talking about this earlier. I think the next 2 years is just going to be about a lot of political noise. Each party is going to try to embarrass the other. It's all going to be about getting ready for 2024, right? And I think that's going to be a really interesting mix that gets thrown into this. So elections aside, I think the big driver of markets and portfolios is going to be the Fed, like we talked about, in inflation. So when I think about what will drive portfolios and asset prices, there's a few questions on my mind, and I don't have the perfect answer to any of them. But here's the big questions out there. Number one, how much further does the Fed have to hike interest rates? Number one. Number two is, how long do they have to stay there? Number three is, what's the impact of quantitative tightening? Nobody knows. Not even the Fed understands the impact of quantitative tightening. They're just going to iterate with the market and find out as they go through this process. How long can the consumer keep spending as their savings rate comes down, as the job market starts to weaken? So these are big questions out there, which we just don't have the answer to. We can take guesses, right? So in the absence of concrete evidence of on any of these fronts, you have to stay defensive, right? You have to have a defensive posture. You have to be maximum diversified. You have to seek income in the bond market. You have to have high quality exposures in your portfolio. So in our asset allocation models, we have increased allocation to fixed income over the last few months. We're overweight bonds. We're neutral equities. So, when I think about the bond market, the level of yields where it is right now, it's really attractive. I mean, they're the most attractive yields we have seen in the last 10 to 15 years, both on nominal terms and real terms. I mean, real bond yields are 1.5% across the curve, and we haven't seen that in 15 years. In fact, just about 4 months back, actually maybe 12 months back, real bond yields were negative. Now they're positive 1.5%. And the level of yields that you have in the bond market now, not only does it give you income, but it also helps you build ballast for the economic downturn which might come. So bonds are at a place right now where it can give you a total return, right? So we're overweight bonds. We have increased our duration in our asset allocation portfolios and in our models. Why? Because I think that, even if the Fed keeps bumping up short-term rates, the long end of the curve is beginning to get less responsive to what the Fed is doing. So the 2-year part of the bond market will start, will keep adjusting along to what the Fed is doing. If it's 5%, we'll go there. If it's 7, it'll go there. But the long end of the curve will be much more beholden to what the economy is doing and what the inflation dynamics look like. So put another way, there's less upside in terms of yield on the back end of the curve than the front end of the curve. So that's why we're increasing our duration a little bit in these asset allocation models. With respect to equities, like I said, we're basically cautious. We are neutral. We have an underweight in international developed markets. So Europe, for example, is underweight for us. The big concern I have with respect to equities is, well, two. Number one is equities are just not competitive right now compared to bonds, right? Where yields are. When I look at a simple metric like the dividend yield of the S&P 500 at 1.6, 1.7%, compared to the treasury market, which is giving you 4%, equities are not attractive. When I look at the earnings yield of the equity market, again, historically not attractive compared to bonds. And all of that is telling us, at least over the next 6 months to 9 months, there's more value in the bond market compared to the equity market. And like I said, equities are still not pricing in that mild recessionary scenario that we are forecasting. So we're worried about valuation. We're also worried about corporate earnings. Now, for some reason, analysts refuse to bring down their earnings estimates, right? It's because companies are telling them that earnings are fine and we're going to be okay. But at some point, and I thought it was going to be third quarter earnings season, it didn't really happen. Third quarter earnings came in okay. They weren't as dire as many were predicting. Yes, margins are going down. The top line is slowing down. Earnings growth is slowing down. By the way, if you look at earnings growth for US companies in Q2 and Q3, it was negative if you take out the impact of energy. If you take out the energy sector, it was negative 5% in Q2. It was negative 6% in Q3. The expectation is it's going to be negative 7% in Q4 if you take out energy. And if you believe that oil prices are going to be on average lower next year compared to where they are today, and oil prices are already beginning to fall because they're anticipating a recession in the global economy, then energy will go from being a tailwind to at best neutral to earnings. So what we worry about is that the market's expectation, even now, is for earnings to grow next year, and they may not. At best, they're going to be flat. Mild recession, they're going to be down 8%. Average recession, they may be down 25%. Really bad recession, maybe down 40%, right? So again, mild recession, we think right now the market is pricing in $235 a share. Maybe they settle in at 200 next year. So therein lies your risk for taking a very aggressive approach to investing in equity. So overweight bonds, neutral on bonds. One final thing, we encourage our clients to look at alternative investments in this environment. when I think about, I talk to a lot of institutional investors, they're all looking at things like equity long short hedge strategies very carefully because, hey, you can take some of your equity allocation and give it to the equity long short sleeve because they tend to lower the volatility, active management is back in focus, they can take advantage of the market moves, et cetera, and they're outperforming the general beta of the S&P 500. And global macro strategies as well, because they're outperforming. This year, managers in the discretionary macro universe have been able to position for the long dollar. They've been short the sovereign bond markets, and they've been long commodities for the most part. So they're doing well. And people love to hit global macro because they really haven't done anything in the last 10 years. But again, they're showing their value now. So you can't really time it. You just have to have it in the portfolio. But there's your support factors in your diversification benefit in your portfolio. Private assets, I do think that markdowns will happen. Mm-hmm. It's natural. Public markets have already taken the hits. Increasingly, you will see private equity markets take those hits, venture capital over the next few quarters. So I think many of the pension funds, for example, which invest 20, 30, 40% of their assets in the private area, they're probably in a little bit worse off shape than they are showing right now. So it's natural, it's coming. But I think the dynamics in the private equity market, for example, are changing. We do see that, obviously there's a tremendous amount of dry powder out there. We're seeing, given the cost of debt financing is so high right now, they're using more equity to finance these markets, these acquisitions. The exit arena is quite bare right now. IPOs are not happening. The appetite for M&A is quite diminished right now. So you're going to see them hold on to these assets a little bit more, and again use more of an equity bent to finance them. But again, you can't time private equity, you can't time private credit, things like that. You just have to have a honest commitment to it with your cash coming in. So overall, I'll end with saying defensive posture, diversification, very important, overweight bonds, neutral equities. We favor alternative investments. But I do think that over the next 3 to 6 months, if you have cash to put to work, you should go in. And in a very measured way, in a dollar cost averaging way, get invested, because we could be looking at a pretty good generational opportunity to buy equities on the cheap.
Absolutely.
Desi, if I can jump in on what Neil said, the challenge when we're out talking to clients too is that there's this recency bias that happens with their portfolios. What worked over the last decade is not what Neil was saying will work over the next couple of years. And it's really hard to shake people loose from thinking, I'm going to buy that awesome, cool idea of a tech name, when we're now talking about buy a company that pays really good dividends and cash flows, right? It's a different mindset. Or bonds. Why would I ever buy a bond, right? And now we're trying to push folks into kind of a different mindset. So the hard part that most of us have is, how do I push out that old mantra that worked for a really long time? And how do we look at and say the world is going to be different? Think about it from this standpoint alone. If we have inflation, the promise of future earnings is not worth as much today, because inflation erodes the value of that future dollar. That's why so many tech names have fallen back to earth, because the promise was always in the future, and that future just became more expensive. So again, ask yourself, challenge yourself, am I doing what was working, or am I doing what we think will work as we move forward?
All right. So we've shared a lot of information. So we definitely want to open it up and hear from you. So I will kick it off. I'm sorry, I can't see that far. I don't have my glasses.
I'm a founding member at Eduardo Colon, and I appreciated everything that's been shared. Just kind of grounding things with the audience you have. You have accredited investors in this room that have a mentality that there is a high risk, high return opportunity when we're looking at companies that are startups, right? So not that every one of us will have the same risk appetite. Some people may decide to invest some of the disposable income, in the 10%, 15%, 20% level or more on some of this alternative investments. But keeping that in mind with this audience, what is the view, right? Because in our case, and I'll make the comment and let you guys comment on that, is there's always been recessions in many cycles. And the reality is some of those small companies today that we're looking at are going to be the medium size and eventually large size companies that will grow. And how is Bank of America and the groups that you're a part of looking at that asset allocation perspective, or folks that are a little bit more comfortable with risk in that?
Yeah. So, I would say that it depends on the liquidity preferences you have as an investor and the risk appetite. We would recommend anywhere from 2% to 25% of someone's portfolio being in alternative investments. And I think it should be a very diversified mix of hedge funds, private assets. Maybe the core of your private assets is that private equity buyout kind of strategy. And then you have some satellites in terms of some private credit. You have some growth equity in there as well. And then I think certain ideas like infrastructure, et cetera, are extremely attractive. So have a core and then build a satellite around that. I will say that there's some core themes that are very, very interesting. First of all, you asked about the different groups and how we think about it. I think the name of the game when you're investing in the private markets is due diligence, right? And we have this, incredible due diligence apparatus department within the Chief Investment Office, 65 people who are looking at all the solutions that we have on the platform. So hedge funds, private equity, traditional managers, et cetera. And they do a deep dive into the performance, risk elements, the quality of management, the quality of portfolio managers. They meet these managers on a regular basis. They're looking at their performance on a quarterly basis. So one of the things that we were talking about the other day with this team is that, hey, with respect to some of these private REIT kind of structures, their values are still elevated, whereas the public REITs are not doing so well. What gives, what's happening? And, admittedly, those values will come down. Big companies which run these private REITs also admit that. So when we have any solutions on the platform, we want to make sure that they are the best in the business. And the same applies to you and your portfolios as well. You have to do your due diligence. But historically, when you go with a manager who has deep expertise in research, experience, global reach, you've done better. You've done better over the long term. There are certain themes that I think are better played in the private universe than it's done in the public universe. So clean energy as a theme, I think it's better played in the private sense. The global healthcare infrastructure build out that's going to happen, the digitization of healthcare, if you will, actually the digitization of pretty much everything. I think there's more interesting opportunities in the private sense. And then more and more private companies prefer to stay private for a longer time. So by the time they come to the public markets, I mean, you know this when you talk to some of these companies, the value has already accrued to the private investors. And then you're, as a public investor, you may not have that much upside. So I'm in favor of slowly, incrementally increasing your allocation to privates, obviously understanding the entire risk picture. And I think thematically, I think also it makes a lot of sense, but it starts with building that core and due diligence as a philosophy.
Eduardo, I want to jump on what Neil was saying. When you work with clients, the challenge that you find is the space is not a place for dabblers, right? And too often people say, I'm going to try a fund, right?
That's right, yeah.
And trying to find that needle in the haystack, the perfect ideal fund, it changes everything for the clients. And they often start down a path and they never complete the path. Our belief is you should have this allocation in the space. So you want to go out and say, how much do I need in hedge? How much do I need in private equity? How do I get into that space? So the discussion needs to go, especially when you're talking private equity and private debt, is this year I should commit $500,000 into the space. I should buy 4 different solutions or commit to 4 different solutions in this space. And that should be decided in January. So when Desi comes to me and says, I've got a really interesting idea, it's not sell me on the concept of taking the risk. I've already agreed to that. Is this solution the right one compared to what else is out there? We deal with this all the time. People buy one fund and then they get K1s for the first time where they have a weird structure that hits their account, and they go, I don't understand this, I don't like it, and they stop, as opposed to saying, make this part of my lifestyle, as opposed to just doing one cool idea. We see it all the time. So clients will have one solution or they'll have 30 solutions. And the folks who have 30 tend to be really happy because they see the value through time, as opposed to the one who says, I just don't understand it.
Hi, thanks for hosting us. And Dave Morales, I heard you talk a lot about the neighbors and trusting the neighbors, and I haven't heard a lot about Latin America. And I'm wondering, with supply chain diversification that could potentially be happening now at post-COVID, how technology has really enabled so many to enable societies to really leap, and then just the interest of there being neighbors. Just would like your perspectives of how you see that as a potential opportunity.
You're looking at me. I get to take that one first. That's a tough one. Thanks, buddy. Yeah. So right. I think the cost, as we start to look to bring manufacturing back to safer climates, if you will, right, for safety reasons, we start to look at who our friends are, right, and I think that's the question that comes up. I saw something just earlier this week that the cost of production in Mexico, the labor costs are about a third of what they will be in the U.S. Now, they were maybe a fifth in the Far East, but as they say, let's shorten the supply lines, let's become closer with our closest neighbors and value that more. Again, I think companies are going to say, do I have to bring it back into the U.S. or can I bring it closer geographically and again, culturally or friend-wise? I think there's a real opportunity there because they're still going to be better off than trying to bring it back in the U.S. and fight the demographics and fight the labor shortage here and fight the cost of this ever-increasing salary. So I think that's a trend that we're going to see. It's not necessarily to the U.S. It's bringing it back to friends of the U.S., if you will.
Yeah, no, I completely agree. I think there's a lot of dynamics at play. First of all, broadly, we are favorable on Latin America as a region because we do estimate that commodity prices will stay high for the foreseeable future. There's a lot of investment that needs to go into the commodity complex and will be in this scarcity environment, at least for the next 5 years. Still, some of these investments come back and give us something on the other side. So we like Brazil, we like Mexico for this reason of friendshoring, reshoring, et cetera. I think they're still very competitive. I think US MCS, or I forget the exact acronym, I think that has developed closer ties between Mexico and the US. And I think that will be one of the biggest beneficiaries as some of the supply chains move away from China. India is competing to get some of this business. They're not there, I think, in terms of the infrastructure. Vietnam is too small. But I think Mexico has a real advantage here. I think AMLO gets that too, right? So, and maybe we disagree on that, but I think he's done some things that are right. So that's overall, we're quite bullish on Latin America. And it's a kind of, and the whole continent as a whole, there's certain countries which are leaping a little bit to the left as well, right? In terms of their fiscal spending plans and things like that. And for example, Lula, I think if he can do a few things right, and sort of, get the debt under control, but do some smart spending, et cetera, I think it'll be very beneficial for that country. And by the way, the technology and innovation ecosystem in Latin America is extremely interesting and attractive. You see this burgeoning venture capital industry, which is doing really well. You're seeing innovation in all industries happen within Latin America. Again, Brazil, Mexico, Chile, et cetera. There's certain countries which are doing very well. I think that's very interesting. And I think I can see a situation where homegrown technology companies in Latin America actually are, pretty good investment over the next, let's say, 10 years.
One last question.
Hi, thank you for being here today on the panel. I'm Julio Calzada. So earlier you mentioned that the private equity world, right, that due to credit, markets have been a little bit slower on exits. Kind of what is the view on when you think that part of the cycle will come back? Because I know for those of us in private equity, right, a big part of getting our check back is the exit. So I'm just wondering what your view is on that.
Yeah, I think it has to do with when risk appetite comes back, right? And I think potentially, third quarter of the year of next year, second half of next year, when I think about the broader economic picture, and I'm like, what turns this around, right? I think about, we'll have to go through this reset period, as Chris Heisey, my boss, likes to call it, right? The reset period for inflation and growth and corporate profits, and that will take us through till the third quarter of next year. So inflation falls, core inflation falls towards the 3% levels. I think that would be a trigger for a new cycle. You can't wait till 2%, otherwise the new cycle will pass you, as you were making the point. The dollar will probably peak out at some point very soon. Earnings estimates, which are beginning to be cut, will start to be get stabilized in the middle of next year and then start to move higher. I think the move higher will come in the fourth quarter, but when it starts to stabilize, I think that's the trigger for risk taking, right? And the job market, jobless claims are very low right now, which is surprising. We're still at 200,000, 225,000 in terms of jobless claims. That's a very tight labor market, but it'll increase. It has to increase. We've had the fastest pace of monetary policy tightening ever. And because of the health of the corporate balance sheets and the health of the consumer, there's been a lagged impact of that tightening to the real economy, but it's coming. And so when the jobless claim starts to rise and stabilize at some point, again, third quarter might be it, then I think you'll be like, okay, all these things are coming together, new cycle, risk on. And I think that's when you will find that risk appetite comes back in the equity markets, in the M&A world. A lot of companies which have stalled their IPOs in the last 12 months, they will come back to the market. And I think that's when you'll see some of that cash flow start to come back in the private universe as well.
All right. Well, this has been a great conversation. So in 30 seconds or less, one thought for the team to take away. Neil?
Yeah, I think that, I talked about, this reset period is a good time to put capital to work and start having those buy lists in place. And the reason I said that is because we are long-term very bullish on, let's say the US economy, right? And why are we long-term very bullish about the US economy? Because I think the next cycle is going to be characterized by an acceleration in innovation. It's going to be a giant innovative cycle in all industries. The kind of innovation we're likely to see in the next 10 years, we haven't seen, if you can believe it, in the last 30 years, number one. Number two is the investments in the energy complex and the commodity complex. That's going to be the driver of the cycle as well, globally. Number three is the millennials. We're in the sweet spot for demographics where there's approximately 5 million millennials, which will be in their most prime age of consuming, earning, and investing and household formation. So to the extent that home building stocks look so bad right now, we're actually in inning 2 of a home building cycle here in the US. That's going to be that's going to be a big benefit as well. And then finally, reshoring, friendshoring, high-tech manufacturing coming back to North America will be the big driver of the next cycle as well. So I would invest to get ready for this next 10 years.
All right, perfect. And
yeah,
Bill?
from the macro standpoint, I would say, first off, thank you all for participating in one of the world's greatest economic experiments. Where you didn't have a choice. Think about the world pre-COVID as a very flat pond. And COVID was a very big rock that was thrown into it. The first wave that came out was the disease itself. The second wave is inflation. As investors, we need to think about what those next waves are. They're going to keep coming. They're not going to be as big, but they're still going to be really meaningful. And that's where the creativity is going to come in. Neil's talked about some of the immediate ones that we're seeing right now. But truly, COVID is probably going to be one of those seminal events where we look out and say, our lives, our values, and the economy was materially different before COVID than after. And I think, again, we need to be really flexible in that period. So,
All right. Well, I appreciate it. I hope that you all enjoyed this conversation. You heard a lot around investment, innovation. Even the millennials now have a good reputation. And getting ready for the next wave. Here at Bank of America, that's what we do. We prepare our clients for the next wave. We can't anticipate. If we did, I wouldn't be here. But, but we do prepare them the best that we can through our due diligence, through our education, through our experience. This has been a privilege for us to be here with you all today. And if there are any questions, you know how to get a hold of us. And with that, I would love to turn it over to Adela Cepeda. And thank you.
Thank you so much. That was such a great panel. There are like 100 more questions, so I hope you'll be around so we can ask them. You brought up all the major themes that are affecting the economy, commodities, innovation, your outlook on neighbors. I mean, it's all so exciting, but there's so many that we didn't touch on, like immigration and do you think the pipeline from Canada is dead? Is there a chance to wake that up? Because we'd be paying $2 gas if we had committed to that. There's just so much, and I can't tell you how much we appreciate this outlook at this time. So, Desi, thanks for moderating between Bill and Neil. They were great. And I can't thank Patricia Pacheco and her team enough for supporting the activities of an organization, Angeles Investors, that 3 years ago was 6 people in a room thinking up how do we bring people together to invest in the future of Latino entrepreneurship. And Latinos have done so much to support this country, and all of us come from that background of seeing parents struggle and want to succeed here in America in a way that our countries didn't enable us to. And the one thing we need is to promise that that search for the betterment is possible and that they're going to have a fair shake in America. And that's what Angeles tries to do. And I know that's what Bank of America wants to do. So I thank you so much for making this opportunity to discuss Angeles a reality. Thank you.
Okay, so from a logistics perspective, I think we got about at 3 o'clock. We'll start with a little bit of an Angeles overview. Roughly at about 4 o'clock, we'll have, or between 3:15 and 4, we'll have some of our portfolio companies kind of share the growth and some of the great things that they're doing. And then at about 4 o'clock, we'll have our startup companies pitch. Where's Veronica? Veronica D'Agostino. She'll be our MC. She's going to do an excellent job, and will be taking us through the program this evening. So we have about an hour or so of just networking time. I think there's hopefully some cookies and things out there that we can chomp on and network, and then we'll be back on at about 3. So thank you, everyone.